You earn a crisp $10 bill. You lock it in a dark drawer to keep it safe, and a full year goes by. That piece of paper is a highly specific tool. We use it to exchange for the goods we want, to measure exactly how much something is worth, and to store value to use later. Without a universally agreed-upon unit of account, we'd be stuck bartering, trying to find a baker willing to trade bread for your old toy car. To avoid that headache, humans invented currency. It shifted from shells to metal coins, and eventually to government-printed paper, which the United States began producing back in 1862. Let's jump forward to the end of that year. You open the drawer, take out your $10, and walk to the store to buy a specific game you've been eyeing. The price tag on that exact game now reads $11. Your bill is identical to the day you put it away, yet it buys less. Keeping cash perfectly still in a drawer guarantees it loses value. The true worth of your money is determined by a massive, invisible system operating entirely outside your bedroom. Moving your cash to a bank is the first step to fixing the drawer problem. A bank operates as an active financial company, not a passive, static vault. When you deposit money into a savings account, the bank puts it to work. It lends that exact money out to a local storefront. The borrower pays a fee. The bank deposits a portion of that directly back into your account, called interest. Even though the bank constantly lends out your cash, your initial deposit remains secure. The federal government heavily protects your money, guaranteeing it up to $250,000 if the bank ever runs into trouble. By paying you interest, banks turn your static cash into a growing asset. This is a necessary defensive move to fight off an invisible force constantly trying to shrink your money's value. That force is inflation. Over time, the average price of everyday things steadily climbs. As those prices rise, each individual dollar you hold buys a little bit less, resulting in a direct loss of purchasing power. The government tracks this using the Consumer Price Index. They imagine a massive shopping cart filled with things a typical family buys every month: groceries, gas, rent, and compare the total cost of that exact same cart year after year. Prices generally get pushed up for two physical reasons. If everyone suddenly wants a limited supply of a hot new toy, stores can charge more. That's demand pull. Or if the raw materials required to make that toy get more expensive, the manufacturer passes those costs directly onto you. That's cost push. There is a third systemic cause: printing too much money. When too many newly printed dollars are chasing the exact same amount of goods, the money itself loses value. In extreme historical cases, this leads to hyperinflation, rendering cash so worthless that kids use it as building blocks. Because inflation is a constant, unavoidable force pulling the value of your dollar down, the national economy requires an ultimate referee to keep prices from spiraling out of control. That referee is the Federal Reserve, or simply the Fed. As the central bank of the United States, it operates as the heart of America's money system, specifically engineered to keep the economy stable. Its primary mandate is controlling inflation. The Fed actively works to keep that yearly price increase at a slow, manageable target of around 2%. A board of governors, led by the Fed chair, meets in Washington to make human decisions that ultimately dictate the environment for every single local bank in the country. Their primary tool is adjusting interest rates, like a financial thermostat. If inflation gets too hot, the Fed cranks up interest rates, slowing down spending. If the economy freezes up, the Fed lowers rates, encouraging people to spend and getting cash flowing again. By constantly tweaking the cost of borrowing, the Fed acts as the ultimate supervisor, ensuring the tug-of-war between banks growing your money and inflation shrinking it stays perfectly balanced. Let's go back to that $10 bill in your drawer. That paper is an active participant, tied directly to every bank, local business, and government policy in the country. Banks attempt to pull your money's value up by paying you interest. Inflation constantly pulls that purchasing power down. The Federal Reserve manages the tension on the rope between the two. Because the Fed intentionally targets a 2% inflation rate, prices will naturally drift upward. Doing absolutely nothing with your money guarantees you will slowly lose that tug-of-war. You can actively protect your cash by keeping it in interest-earning accounts. You can pay attention to the shifting prices of everyday goods, and you can recognize how the Fed's changing borrowing costs affect your own budget. By understanding how money, banks, inflation, and the Federal Reserve connect, you possess the power to actively protect your value and make smart financial choices in the adult world.